Welcome to this explainer. Today is July 1st, 2026, and we are breaking down an absolute market shockwave. If you've got capital deployed in US equities, crypto, or global bonds, well, your portfolio is waking up to a completely new landscape. Our goal today? To translate all of this unprecedented market chaos into absolute clarity.
Because, honestly, today isn't just another trading session. We are looking at three massive catalysts converging simultaneously, and they are completely rewriting the rules for your portfolio. Just looking at today's timeline, we've got historic milestones on Wall Street right at the open, a fundamental shift in how the Federal Reserve handles interest rates, and a massive regulatory hammer finally dropping on the crypto space in Europe.
So here's our agenda to navigate this chaos. First, equities at record highs. Second, Fed policy under the Warsh era. Third, crypto's regulatory meltdown. And finally, number 4, the Q3 investor playbook. Let's get right into it.
Section 1. Equities at record highs. Wall Street's historic quarter.
Right off the bat, driven by relentless tech optimism and a massive global hunger for AI hardware infrastructure, the Dow Jones Industrial Average has just surged to a fresh record high of 52,319. It is absolutely wild to see. The Nasdaq and S&P 500 are also showing incredible resilience today. And this isn't just isolated to the US either. Global liquidity is chasing this exact same momentum. If you look overseas, Japan's Nikkei 225 just surged over 1.6%, heavily tapping into that cross-border AI hardware demand. The momentum right now is just staggering.
But as we start looking a bit closer at the underlying data, a very clear structural divide is forming in the markets. It's kind of becoming a tale of two tech sectors. On one side, you have the AI infrastructure builders. These are the physical microchip and data center companies, and they are riding a massive wave of hard capital expenditure. On the flip side, you've got the AI software monetizers. These are the companies that are really struggling to actually turn a profit on this incredibly expensive tech. Enterprise clients are looking at their massive AI token consumption costs and, well, they're starting to pull back, simply because the return on investment just isn't there yet. So the rising tide is no longer lifting all boats, and we have to be incredibly selective.
Moving on to Section 2, Fed policy, the Warsh era, a fundamental regime change. Just take a look at Chair Kevin Warsh's exact words here. The central bank's stance right now is incredibly hawkish. By keeping borrowing costs painfully high at 3.50% to 3.75%, the Fed is sending a crystal clear message. Inflation is proving so sticky that rate cuts are effectively off the table until 2027. No way around it. In fact, Wall Street is furiously pricing in the distinct possibility of yet another rate hike before year-end. Higher borrowing costs? Yeah, they are simply the new normal. And this brilliantly illustrates what economists are calling the death of forward guidance. The Fed has officially killed the dot plot. For years, investors heavily relied on the Fed signaling exactly when and how much they plan to cut or raise rates. Well, that era is completely over. The Fed is no longer going to hold Wall Street's hand, and they are moving to a strictly data-dependent model. This forever changes the risk dynamic, especially for those high-debt growth companies that absolutely rely on predictable, cheap capital just to survive.
All right, Section 3, Crypto's Regulatory Meltdown, MiCA, takes effect today.
A brutal wave of global risk-off sentiment has absolutely slammed the markets today, forcing Bitcoin's price action below the $59,000 mark. It's currently retesting major macro support levels that we frankly haven't seen since early 2024. The entire crypto heat map is flashing red today, as institutional capital reacts to a massive shift in the regulatory landscape overseas, which is spilling directly into US markets.
And this table maps out exactly why this meltdown is happening right now. The primary catalyst? The European Union's MiCA regulation, that's the Markets in Crypto Assets law, is fully enforceable as of today. This is putting massive compliance pressure on global exchanges. Binance, for instance, has officially curtailed operations and restricted non-compliant services for regional users, and that's triggering some serious capital flight. But beyond exchanges, there is also a huge corporate stablecoin war erupting. The Coinbase and Mastercard consortium just launched their new OpenUSD, causing major market fragmentation and sending competing stablecoin operators like Circle's parent stocks down a heavy 16%. It is just a really painful compliance migration across the board.
Finally, let's look at Section 4, the Q3 investor playbook, where to deploy capital and danger zones.
So with equities dividing, the Fed locking rates, and crypto bleeding, here is exactly where you want to deploy capital.
First up, double down on the physical microchip and data center hardware layer. The global demand for advanced cooling and physical infrastructure remains totally insatiable, backed by hard corporate capital expenditure. Second, look at high-quality sovereign bonds. With the Warsh Fed locking rates deep into next year, you can secure exceptional low-risk cash flow by locking in those high 3.50% to 3.75% yields with U.S. Treasuries. And third, you want to target defensive megacaps. We're talking about companies with massive cash reserves that do not rely on floating bank debt. You want businesses that can self-fund their own growth, completely regardless of what the Fed does.
Conversely, let's talk about the danger zones you absolutely must avoid. First, whatever you do, avoid catching the falling crypto knife today. The MiCA enforcement is going to take weeks to fully filter through global liquidity pools, so definitely wait until a firm regulatory floor forms. Second, steer clear of overvalued AI software firms. Like we noted earlier, enterprise clients are aggressively cutting back on their massive AI token consumption costs. If a software company is relying purely on AI hype without a structural revenue model, they are in serious trouble. Finally, drop European-reliant auto tech suppliers. We're seeing real macro warnings from companies like KPIT Technologies projecting lower revenues due to spending cuts by European automakers. If they rely heavily on EU corporate spending, just keep them out of your portfolio right now.
So the second half of 2026 is starting with some very clear lines drawn in the sand. Now, I really want to hear from you. Are you buying this massive equity rally today, or are you holding cash and waiting for the dust to settle? And more importantly, what specific sector or asset class from this global update would you like us to expand on for our next Explainer deep dive? Let me know down in the comments. Make sure you rebalance your portfolios accordingly today. Stay safe out there, trade smart, and I'll catch you in the next Explainer.